Good afternoon, everyone. Tom Springer with Snyder Downs. I'm a shareholder. I'm responsible for strategy and transaction advisory services. Today, we're going to talk about various complexities of tax strategies and considerations as it relates to transactions. And today, I'm joined by Justin Steele. He's a shareholder who runs our tax advisory services as well as a practice unit leader. Welcome, Justin.
Hey, Tom. Great to be here.
So to get started, let's just jump right in. There's often conversation around different forms of an organization, and does it really matter with the different forms? Can you give us a brief highlight of those different forms of an organization and why it would matter?
Sure, Tom. Yeah, it absolutely does matter. From a tax perspective, there's really three primary forms of organization: S Corp, partnership, and C Corp. And for all intents and purposes, S Corps and partnerships are taxed at the individual level. So the gain or loss at those businesses flows through directly to the individual's 1040. On a C Corp, there's an extra layer of tax at the entity level. And so how those types of organizations are taxed on a potential exit transaction is very different.
Oh, excellent. Thank you for that answer. And with that answer, too, often when we're in a transaction, there's a discussion and sometimes a conflict or a rub relative to an asset sale versus a stock sale. Do you mind giving us a little bit of an overview of what the difference is and why it matters?
Sure, not a problem. And you're right, there's always a rub around asset versus stock sale. And it really relates to the objectives of the buyer and seller in the transaction. On the buy side, buyer is going to want to receive a step up in basis in the assets that they purchase. And the way to do that is to buy assets. The step up in basis allows the buyer to reduce their tax liability on a go-forward basis because they will be able to amortize or depreciate the underlying assets of the business that they purchased. On the sell side, the seller's intent is to reduce the amount of taxes they pay on an exit event. And the way to do that is to pay tax at a capital gain rate. Generally, that's going to be a stock sale that allows a capital gain rate. And so there's always a rub between buyer and seller as it relates to asset and stock.
Yeah, no, excellent answer. And in addition to not only the rub with the tax consideration between asset and stock sale, there's a legal implication as well. Without getting real deep into the legality of it, what is really the issue or the concern between the buyer and the seller, between stock sale and asset sale, legally speaking?
Yeah, great question. I would say, generally it's on the buy side. What is the buyer buying? Mm-hmm. In an asset sale transaction, the buyer can specify what assets of the business they are purchasing, which ones they are not. The same goes for liabilities. Generally, in an asset sale, the buyer is not going to acquire liabilities unless they're specified in the purchase agreement. In a stock transaction, the buyer is acquiring the stock of the business, which comes along with all the assets and all the liabilities of the business. So in a lot of ways, the structure of the transaction informs the next phase, which is due diligence. And so in a diligence process on an asset transaction, the scope may be a little bit more limited than it would be in a stock transaction because the buyer may not be acquiring liabilities. Whereas in a stock transaction, liabilities are coming along. So buyers are going to want to know what are the liabilities both recorded on the balance sheet and the financial statements, and what are those that may be unrecorded or undiscovered.
Yeah, no, excellent answer. And there are different strategies that we won't talk about today to work through those issues, but we'll bring that to you in another series. As we work through transactions, we often want a mutually beneficial engagement and ultimate success for both the buyer and the seller. And when we try to negotiate some sharing of the burden of the taxes, if you will, there's other things that are negotiated, and often they result in different forms of consideration. So with different forms of consideration, can you give us just a high-level overview of how buyer structure deals and what those forms of consideration are?
Great question, Tom. So we see really two primary forms of consideration in most of the transactions that we work with. One of those is cash, obviously. Mm-hmm. The second is some form of equity, either in the seller's business or some other business within the structure of the buyer. And the tax effect of those forms of consideration varies depending on the transaction. Generally, when a seller receives cash, that's going to be taxed at the time of receipt. How the rolled or retained equity is taxed depends on the form of the transaction. A lot of times there are opportunities to defer tax on rolled or retained equity. Most sellers will ask buyers to structure a transaction in that way, but with it, like anything else in tax, it just sort of depends on the specifics of the transaction we're working with.
No, excellent answer. And the complexities related to those strategies, we have sophisticated ways to handle those. Too deep for this particular series today, but we'll get into those strategies later. With the different forms of consideration and the negotiations in the deal, every dial turns. So as we ask for one thing on the sell side, the buy side asks for something else, and it's trying to reach a mutually beneficial outcome. But with all that said, what are the most common tripwires you see as it relates to taxes in transactions?
Yeah, great question. I think there's a couple that come to mind. Certainly for domestic companies, state and local taxes, significant complexity around state income tax, significant complexity around sales and use taxes, typically in a diligence process. That's an area of focus, and a lot of times we see, filing requirements that haven't been met, taxes that perhaps haven't been paid, and so that's an area that we certainly focus on very frequently within a domestic company. With companies that have operations beyond the U.S., obviously, similar to state and local taxes, international taxes tend to be a very complex area of the law, and so we will focus there and make sure that all the obligations internationally have been met. And what we find frequently is there's issues because of the complexity.
Justin, thank you for that answer. And as we close out this particular topic, we've just scratched the surface on the complexities related to tax consideration, legal structures, and things of that nature. It's just, again, high level information. However, what's really important is that we get you and your team engaged early. If we get you and your team engaged early in a transaction, it often results in a better outcome because we can prevent these surprises in diligence, and we can also mitigate certain things from occurring if we're proactive with them. So why it really matters to you? It matters to you because if we are proactive and we can prevent these discoveries from occurring, it ultimately will help us increase the enterprise value or hold our enterprise value to a higher level, which results typically in a higher purchase price. So again, we really appreciate you coming out today, Justin, and appreciate everyone for participating in our topic today. Thank you.